If you're a veteran and you have benefits from the VA and you're looking to purchase a home, you are in luck because as of April 7th of 2023, VA lowered their funding fee. So that means that it's going to cost you less to get into a home. So this video is going to cover what the fee is, how to calculate it, how that's going to benefit you so you can be on your way to owning a home. I'm Jen Hernandez, Loan with Jen. Welcome to my channel. Here you can find all facts, real facts, no BS, with all your questions about buying a home. Let's get started. What is a funding fee anyway? It is a one-time payment that's calculated by the VA. There's certain calculations that we'll go over in a minute, and it's either added to the loan or you can pay it up front. Now, most veterans don't want to pay it up front because they're getting in with 0% down. This is a wonderful benefit of a VA loan, is 0% down in most cases. But this funding fee is calculated, and again, it's added to the loan or it can be paid up front by, for example, a seller closing costs that's been negotiated. So we'll talk about that a little bit further. There are exceptions to the VA funding fee. If you are a disabled veteran, you can be any percent disabled. Now it has to be a disability through the VA. So if you were declared disabled after you were discharged, just through, whatever medical event that you might have had, that won't count. You have to be discharged or considered and receive disability benefits from the VA. But lots of benefits there. That can save you thousands of dollars by not having a VA funding fee if you're disabled. Also, if you're a service member in active duty and you receive a Purple Heart prior to closing, you are exempt from the funding fee as well. When is the funding fee paid? It's paid either by rolling it into the loan or it can be paid at closing in one lump sum fee. So that's a perfect way for a seller credit to pay the funding fee in full if that's what you negotiate. So what are the funding fees? Like what are the numbers and how is it calculated? So I'll put a chart here that explains, and we'll keep it on the screen for a few minutes, that really explains what the funding fee is. So there's two types of designations in a funding fee. It's either first time use, meaning you've never used the benefits before, or it's a second time or third time or fourth time use. It's a subsequent use. So if you put 0% down, you'll see on the chart it says less than 5% down. I mean, if someone's gonna put 3% down, trust me, they're putting 0% down. So let's just say 0% down. Your funding fee is actually the highest. Now, if you put 5 or 10% down, those are different milestones. If you put 5% down, the fee goes down a little bit. 10% down, it goes down a little bit more. Now, there are people that do put money down. They might sell a house and be using those funds to pay it down. Not everybody does 0% down. So there are some lower funding fees available. Now, recently, as of April 7th, 2023, the fees did reduce. It was about a 0.2% savings in almost every category. So this chart reflects the fees with the reduced fee with the reduction after April 7th. So for the example of how to calculate, we're just gonna take an example of a $300,000 loan. Let's just say that the house is $300,000, you put 0% down and you're financing $300,000, okay? And it's your first time use. So you can see on the chart again that your percent funding fee is going to be 2.15%. So if you take 300,000 and you multiply it by 2.15%, that gives you $6,450. So as we mentioned before, you can either negotiate with a seller to give you a closing cost credit to pay for that at closing, or you can roll that into the loan. So that would be 300,000, which was the original price, plus 6,450. So your new loan amount is 306,450. That's a mouthful. So that would be your new loan amount. And that amount is amortized over the 30 years at your interest rate. Now, I did some quick calculations before I made this video when I was making my outline, and I calculated it, and it's approximately, so spread out over 30 years. It'll of course depend on the interest rate, but it's an approximate $40 difference in your payment. And VA did that for a reason. They didn't want to give veterans the burden of having to pay something like that up front. So they thought, you know, we're going to spread it out over 30 years so it's less of a burden. And the reason for the fee is just for the benefit of doing the loan. They're giving you 0%. There's a lot of other benefits like no PMI. There's no PMI at all. So it's, I don't want to say it's a payback, but it's like a risk assessment that they're taking just to, you know, pay for fees. There are some people that foreclose on the loans later on down the line. So funding fees on the government loans are a necessity. And so they do have to be paid, except, of course, remember, if you are either a Purple Heart recipient or disabled, then you don't have to pay it. So that's great. Probably stop watching this video, but we're glad to have you on. In fact, if you're having a good time, if you're learning a lot, please give me a like. Let me hear your questions. Just comment below, and I would love to hear your questions. Also, at the end of this video, we are going to put VA loan basics, so you can also hear other things like income and credit, and know how to qualify for a VA loan. Thank you so much for watching. Talk to you soon.